How do you build a high-performing culture? This is Culture Architects. Candid conversations with extraordinary leaders sharing their biggest successes, failures, and lessons learned on their culture journeys. Here's David J. Friedman.
A couple of years ago, I had the opportunity to work with Argosy Private Equity for a summit that they had hosted with their CEOs. I've also done that with their HR professionals as well. And Argosy is a lower middle market private equity firm that's based in Wayne, Pennsylvania, founded back in 1990. And anyway, having worked closely with Argosy over the years, one of the things that has always been interesting to me and I've been fascinated by is how different they are from other private equity firms, at least that I know of, specifically in the way that they look at culture as a competitive advantage. And because of that, perhaps the support that they put behind culture. And I would say their track record speaks, for itself to the impact of that approach, as they were acknowledged in 2025 as a top 50 PE firm in the middle market. And that's recognition that they've received, multiple times, I think, in fact, the fourth year in a row. So today on the Culture Architects show, I'm pleased to have with me two partners from Argosy Private Equity to dig deeper into their approach to culture. So we have with us Lane Wiggers, who is the managing partner and an operating partner, and he's been with the company since 2015. And we also have Don Charlton, who is a deal and operating partner, and he joined Argosy back in 2010. So this is the first time on our Culture Architects podcast that we've looked at this from the private equity perspective, and I think it's going to be really an interesting conversation. So, Don and Lane, welcome to the Culture Architects podcast.
Thanks, David.
Yeah, thanks. Thanks for having us. It's great.
So, before we get into the work that you do at Argosy, I'm always interested, for our listeners' sake, to get a little bit of history, a little background as to where you're coming from. So, let's start with Lane. So, I saw that you were an engineering student, right, before you got into this world. That's kind of a different background. So how did you get into the private equity world?
Yeah, that was a few years ago, David, but absolutely. So, I grew up, in northwestern Pennsylvania, and I wanted to go south. So I went south to Clemson University and ended up in mechanical engineering there, graduated, a little bit of experience during school at Cummins Engine, and then also at Cooper Tools, and then also, kind of migrated there full time to Rockwell and worked in, manufacturing, plant management, just operations for several years prior to going back to business school. Mm-hmm. And then came out and did aerospace and defense investment banking for a handful of years. And then found myself kind of right after 9/11. I guess it was 2002. Kind of got into the buy-side world, the private equity world, more as a kind of an independent sponsor, fundless sponsor, they used to call them. And then migrated to kind of a hybrid family office, and then ultimately at Argosy about 11 years ago. So, a bit of an unusual path to get to where I'm at today. So,
and what's interesting about that, at least to me, is that you've had such a wide variety of experiences, which gives you maybe a broader perspective on what makes companies successful than perhaps some others might have.
Yeah, I think, our whole operating partner team has been involved in business. We're not all just pure kind of finance investor backgrounds. We have operating background somewhere in our history. And I think that does give a perspective on what makes a company tick and what makes the people tick and what drives engagement and really how you can foster the right culture and get to a better spot.
Yeah. So, Don, how about for your background? How did you get into this world?
It was long road to get to this world. It was a goal of mine to get to this world. I had a mentor who was in private equity and aspired to do what he did. So I started my career at Coopers & Lybrand, a public accounting firm. Back then it was a Big 8. Now it's the Big 4. Then I did a stint with Baxter Healthcare, so working for a Fortune 500 company. Then I worked for a small PE shop here in the Philadelphia market, doing similar deals like Argosy did, but on a much smaller scale. And then did startups down in the Washington, D.C. area prior to joining Argosy, which was great experience. One of them was very successful. It was the Inc. 500 #1 fastest growing private company in the United States in 2004. We ended up taking that company public. I was employee number 3, and when I left, we had 700 employees.
Wow.
No revenue when we started, and $450 million when I left. So that was a great learning experience for me, and learning about culture and how important culture is to a startup that grows that fast when you're adding so many people so quickly. And Argosy had invested in that company, and I had an opportunity to wanted to move back to the Philadelphia area, and had the opportunity and took it. And it's been a great 15-year run so far.
So Argosy's investment in that company is what connected you to Argosy.
Correct.
Got it. And so let's go right to both of you and Argosy as a company. You have this appreciation for the importance of culture. Where does that come from? Like, what causes you to think that, in your experience of looking at lots of companies, that culture matters? All right, we'll throw that to either of you.
Yeah, Don, you want to take that one?
Sure. I think culture is very nebulous. I think we all know when we're in good cultures and when we're in bad cultures. But I think it's tough to really define all the attributes of what makes a great culture. So I think part of the impetus for me in my investing career here at Argosy was actually meeting you, David. I'm in a Vistage group, have been for the last 8 years. And I heard you speak, and it's one of the reasons that I enjoy Vistage so much is I get to hear impactful speakers, and I try to take the content from those speakers and try to deploy it into our investments within our portfolio. And I just was really taken back by your focus on making culture purposeful and trying to ritualize that. And, many times, we'll have cultures in our portfolio companies that need improving, and some of the tools that you use with your company, and you've worked with several of our portfolio companies, are just really impactful, trying to make culture purposeful. It gives kind of a roadmap for management teams and employees to be able to work towards a really healthy culture.
So, I mean, that makes obviously logical sense. And of course, I am a culture guy, so I'm certainly going to agree with that. But there are many of your peers in the private equity world, of course, who would look at this as, I suppose, look at things, and you can tell me more, but look at things from a more of a transactional perspective. And yeah, you're there to make money. You're there to grow these companies and get a return on investment for your investors. And so many of them would say, that culture stuff, that's all nice, but we got money to make here. We're trying to turn this thing around and figure out, how to change the products or the competition and win business and grow this company. And so we don't have time to work on that kind of stuff. Lane, I mean, why do you think many of your peers think that way, and why do you think differently?
Yeah, so I think it goes right to, what Don said. It is a nebulous thing, right? Like, describe your culture. It's one of the questions I ask when I interview executives is, what's the best culture you've ever worked in? What's the worst one? And the way it's described 8 out of 10 times is just a wandering, it's not really an answer, right? And these are experienced executives. And so it's hard, right? It's this nebulous thing. It's hard to drive in a direction. I think there's a perception that it just kind of happens. And, to echo what Don said, I think you kind of opened our eyes early on. I think we always thought it was really important. I think we struggled with a tool or a process to kind of drive it in the right direction. But I think we've always recognized, in our, investing history that, back up a little bit. So Argosy often invests 80-90% of the time in founder-owned businesses. So where the founder's probably transitioning, probably retiring at some point. It could be at closing, it could be in a year or two, but that's the typical range. And so, we invest in good, strong, healthy, growing companies. And so, I think we always recognize, well, how do we kind of keep the good parts of that culture when the executive, the leader, the owner's kind of transitioning away? And how do we kind of keep the good and maybe tamp down the bad? So I think we always appreciated it. But we, before meeting you, kind of lacked the process and the understanding on how to shape it. So I don't know if it's necessarily that maybe some of our peers don't appreciate it. It's probably they just don't know how to execute and change it. But I think that world is changing. I think private equity started back in KKR and the Barbarians at the Gate and kind of that history a long time ago. That was pure financial engineering. Right, pure financial engineering. It was buy it for this, cut these costs out of it, sell it for that, and that was the way you got a return. That has melted away. There's a lot of competition out there now. There's a lot of smart folks thinking about the kind of the financial engineering side of it, and that's melted away. And I think the operating partner world has flourished in the last 10 or 15 years because the financial engineering is kind of table stakes at this point. And so how do we compete and get an edge? Well, it's operational improvement, and the next frontier is culture. That's how we kind of look at it. And if you can get culture right, it solves a whole lot of other things by itself. So yeah,
it's interesting you make that comment. You're good, Tom.
Yeah, I was going to say it, and it can be difficult. Especially when you have a founder who, has been with the company for 20 or 30 or 40 years, maybe has a command and control style, not very collaborative, not very customer centric. So a lot of times it takes a leadership change to really kind of ignite getting the right culture for the company to thrive. But it is difficult.
As you're saying that, Don, I'm thinking about some of the companies that we've worked with, most of which are also founder-led. And often if they're multi-generational family businesses, and I suspect many of your companies are probably, if you're in that zone, a lot of family businesses. And if they're multi-generational family businesses, my experience is that often you've got let's say a founder who's, I'm going to put age range, 70, 75, something like that, and they're ready to move on. And when they grew up in business, culture was just a bunch of fluff in their mind. And so, you don't need to do that culture stuff. You just take care of your customer and everything else will take care of itself. And they tend to talk like that. And so they see their next generation, maybe it's their son or daughter who's now running the company or whoever else, talking about culture. You don't need that stuff. And one of the things that I have found has been helpful in those conversations is when we talk to that founder about preserving their legacy. So typically that founder did at their core, they did believe in certain things that really made a difference about how you take care of people and how you take care of customers. They just sort of poo-poo the documentation and more intentional aspect. And they think of it, in my view, in somewhat of a naive way, that if you just set a good example, everyone will just figure it out somehow, and you don't need to talk about this stuff. And so if we describe to that founder that what we're doing is preserving your legacy, there were things that you stood for that really were meaningful, that helped to grow this company. And if we can't document that and teach it to other people, we're going to lose that when you move on. And that I have found to be an effective way, because that resonates with them. They do want to preserve their legacy, but they typically have not seen culture or the work on culture as a preserving of legacy. They see it as a bunch of new age fluffy BS that you shouldn't have to talk about, because we're talking about hardcore business here, not that fluffy stuff. So sometimes just reframing it in terms of a preserving of their legacy can make a difference.
But I think you nailed it, David. Like, I don't, just think about my grandfather, business person, and, the word culture, I mean, he wouldn't even know what you were talking about. But, he had a style and a way that, he would walk out in the shop every day. He knew everybody by name. He'd, say something about them, and, that kind of transparency, honesty. I mean, he had very discrete values, I think, but they weren't written anywhere on a wall, right? They were just kind of lived by him, and so I think those things exist. Culture exists in my grandfather's business, or maybe some of these businesses we're talking about, these multi-generational businesses. It exists, but it's just not documented and framed in a repeatable way.
Yes.
So I think, you said it better than I did, but it's there. It's just not documented, and it's not framed as culture. It's like exactly what you said. This is how I'm going to act. Everybody else should kind of follow my lead in a lot of different ways, maybe.
Yes.
So and I was just going to say, and that's exactly the kind of the transition that, across Argosy's history, we've done I think almost 140 platform investments, and that's not including add-ons. That's just pure kind of platform investments. And so, and again, 80-90% of those are family founder-owned businesses. And you said it. I mean, helping to preserve the legacy and preserve the goodness in that culture. And there's usually some pieces maybe not so great in there too. But kind of setting a path and trying to drive to that, it's just super important. We find it a competitive advantage.
I'm imagining, as I'm listening to you, Lane, I'm thinking about, as it relates to culture specifically, but we could even broaden that most of those companies, those founder-led companies, are, I'm going to say, relatively unsophisticated, and I don't mean that in a derogatory way, but they're unsophisticated in their approach, certainly to culture, but many other parts of their business. And they tend to have, I sometimes say, a naive view that, you set a good example, you take care of the customer, and everything else will work out on its own somehow. And they tend to think that, bringing more rigor to how you approach things is like, it's not what they're about. They see life in maybe a simpler kind of way. And I imagine you see that as it relates to many other parts of the companies that you're working with. Culture, we're here to talk about culture, but even the non-culture areas, they probably, I'm guessing, have not been particularly rigorous about a sales process or a playbook or other management practices. Is that what led to your whole, your value acceleration methodology?
Yeah, I know. I think many founders and many organizations are insular. They don't seek out peer networks. The good thing about Argosy is, we've been around for 35 years, done 140 platform investments. We made tons of mistakes, right? And learn from those mistakes. And I think we try to codify those mistakes and make sure our team internally knows that and can share that with our portfolio. So I think that's really important to, but it's a struggle for some founders. But we know what good looks like, right? When we have success and we're able to turn around cultures, we can see what an impact it can have on results and the return you get from a healthy culture. And contrary, if you have a culture that's caustic, you can see how much damage that can do to the value of a company. Culture is super important to us. So, when we go to pitch a management team, typically we start with culture. We first off, we'll start by, like, one of the first slides in our deck when we're presenting Argosy is our core values. And we tell the management team, like, here's our core values. We act with integrity. We foster a collaborative environment. We achieve success through perseverance. We win with diversity, and we celebrate achievements. So that's what we usually start out describing who Argosy is. And we typically say, like, if you don't espouse kind of the same values that we do, this is probably not going to be a good fit for us. And look, we have killed deals in diligence very early on in diligence when we have indications that the culture isn't one we think we can change, or like safety is super important to our portfolio companies. We had an incident where we were interviewing a team member, and there was an accident in the plant. and management didn't stop the plant. They someone lost a finger and they kept operations going. So that's not in tune with the kind of teams we want to invest in. Put it that way.
So how do you? I mean, Lane, you referred to before that one of the questions you ask somebody when you're interviewing a leader is about their culture. But I'm curious. I mean, everybody, when you're making an acquisition, you want to make sure whether it's a platform company that you're buying for the first time or an add-on that one of your companies that is making an acquisition to fold in, you're trying to make sure there's a good cultural fit. So how do you go about assessing that?
Yeah, so I think it's time on the ground, just kind of understanding the people, and asking those questions. And I think if you ask about their culture, about their values, and there's a lot of kind of looking at feet, kind of stammering around, like that's one answer. I think what Don was particularly talking about is when. And we deal with a variety of different cultures, across 140 different platform investments. Of course, everyone's going to have their own culture, but there are some that we just go counter to our culture that, it's just not good fit for either of them. So, kind of a transparency issue would be, that's a real problem for us. If you can't we're partners, right? We're providing, the majority of the capital. You're providing the operations, but we are truly partners here. And so if there's not transparency back and forth, and that's a two-way street, 100%. If there's not transparency, if there's not honesty, if there's not integrity, if there is, an opposition to diversity, those are just things that we will move on and wish folks well. And, it's just not for us because, we have been on the other side of that where there hasn't been, a good culture fit on those kind of red line issues, so to speak. And it's no fun for anybody. I mean, it makes for a long investment cycle. But it's difficult to assess. We certainly use some, different assessment tools. I think, their openness, to having the conversation about their culture, understanding what, what drives them and their people. And I think that all, kind of happens kind of on the ground. So, not easy. I'm sure you have better tools than we do to assess it.
We may not. It is hard to assess. And often I find, and I suspect this must be a challenge for you, that the CEO or leader's view of or description of their culture may not match the reality of what's on the ground.
Sure.
That, know, when you read the article in Inc. magazine about, their amazing culture, often if you interviewed the employees, they'd say, well, that's not what we're experiencing here.
Yeah.
So even if you talk to that CEO, they may just have a distorted point of view about how wonderful it is.
I would agree with that. And it's very hard to really get at what the true culture is because many times, and look, this is a big event for a founder, right? They're going to get a big check. Could be their life's work and they're, handing over their baby to another partner. But sometimes it's curated. How they're describing the culture. It's what they want us to think it's like, right? And then, we pay attention to little red flags, like we're at a management meeting and I ask a question to the controller and the controller looks to the CEO before he answers the question. That's a little bit of a red flag. So, as Lane said, it's super important for us. We try to spend as much time as we can with senior executives and even the middle management layer. And many times we don't get exposure to the middle management layer because, it's being kept confidential, which I can understand. But many times it's getting to that middle management to understand the true culture of a company.
Yeah.
And once, and David, once we close, I think we obviously have much broader access, and we do use a couple different tools. We have a variety of different employee engagement tools that we use here at Argosy. We've started using a 360 tool that kind of measures us all and kind of grades us all on our how we stack up against our 5 values. We do use some assessment tools like Hogan or DISC or Caliper, those types of things. So those are generally happening, maybe a couple of those things pre-closing, but most of them post-closing. So I think, if we don't find anything where somebody's crossing the red line of our values, those key kind of core values that we talked about, we kind of get to the other side. I think we get a lot better view in, and, with some of those tools that we're allowed to use to kind of assess after the transaction, we do get I think a much better view of, maybe pull the veneer off a little bit, kind of really understand what the employees are thinking through these engagement surveys, some of these 360 surveys. And, with that, I think we can get a much deeper understanding of it and, understand if we need to kind of shape it again, kind of accentuate the good and maybe tamp down some of the bad.
So
yeah,
the
one thing.
Go ahead.
Go ahead. Lee.
I was just gonna say, I wanted to roll back just to maybe a couple of minutes in the conversation. We were talking about founders and maybe they're I can't remember the words used, but I think founders haven't spent a lot of time thinking about this, at least in our world, because the companies are small enough that they can touch all of the employees. That may be a touch of a stretch, but just think about my grandfather. He could walk out in the shop. He knew everybody's name. He knew their families. If somebody needed a loan, no problem. Let's have a conversation, those types of things. But quadruple the size of that business, there's no way he could do that all himself. Like no one human could do that. And so that, I think, is where we can come in, and you can come in, and the executives, the leaders can do it themselves. But I think at the kind of the retirement ages where we've been talking about it, the multiple generations, they're probably not ready for that. But you can create and drive the kind of the right culture, drive the right culture, drive the right values, and document that and make that more scalable. So you can take it from a 50 or 60, 70 person company to 700 and still get, the same or even better results. So I wanted to roll back to that a little bit, because I think it's important to recognize that I don't think some of these founders have been put in a position to need to do it, because they could kind of manage it in the size company that they're.
Yeah, I think that's a great
leading.
point, Lane. And I would add to that. In my experience, there's sort of two dynamics that both of these dynamics lead to the same conclusion that you need to be more intentional about this. One is your point, size. That yes, when we're small, we can see everybody and touch everybody and talk to everybody, and people could kind of pick up the vibe just by being around the leader. And that was good enough. Doesn't mean it couldn't have been better, but it can carry the day, which they can't do, as you point out, when they get bigger or they make acquisitions and now there's a lot more people. The other dynamic that I think has had a similar impact is just the shift to remote work. That even if it's a smaller company, even if they haven't grown, when they used to be physically proximate to each other, they could pick up that vibe. And now that so many of them are working remote or hybrid, even in a smaller company, they're not seeing each other. And if there isn't some method by which they're being more purposeful or more systematic about driving that culture, how do you maintain that when we don't see each other anymore? And I see that happening as well.
Yeah, that reminds me of the first time we really implemented your system, David, was at a company, one of our portfolio companies that we've exited, called Library Systems and Services.
Yes.
Distributed organization, 85 locations, a corporate headquarters, and then 85 branch libraries. And they grew fairly quickly over the years. And there was kind of an us versus them mentality. The branches thought, oh, big corporate, you guys just sit up there in the ivory towers and tell us what to do. And implementing your process, and at Library Systems Service, we came up with 28 fundamental behaviors that really define the culture of library systems and services. And boy, it was amazing to see the walls broken down and everybody getting on the same page. And part of the techniques of ritualizing these behaviors, CEO would email out all the employees every week with a fundamental, starting meetings with giving examples of these types of behaviors that we want all the employees to be known for. But just amazing results being able to turn around that dysfunction using your tools.
Yeah. So let's talk about results, because again, you're in the business of trying to help companies grow and, get a return on investment. And so not surprisingly, one of the questions that we're often asked is, okay, yeah, I get intuitively that if our culture is better, we're going to be more successful. It would be hard for anybody to disagree with that basic point of view. But I'm often asked, so how do you measure that return on investment? You guys are, that's your whole business, is to get a return on investment. How do you answer that, or how do you think about that? If you're going to spend money on anything that you're going to do in this company, it's got to get a return. So how do you think about that as it relates to culture?
It's a tough one. It's kind of like marketing spend. You
you
throw dollars at it and you hope it works. Now, I think, we do try to track some metrics around it. So, employee engagement survey would be one of them. So, we're tracking that year over year. We try to keep it fairly consistent, and the goal here is to drive that score up every year. I think it's. Sometimes what we see is there's some low-hanging fruit. In the first year, we're able to go from, a 65 to a 75. And then the next year it's 75 to 80. And then next year it's 80 to 82. And, there's a kind of a flattening out at some point, I think. But, that's one way. I think, another measurement, non-financial measurement, but is when you walk into a company and, are they living their values in their own way, whether it's, using kind of your tool around, 15, 20, 25 behaviors, and, they're starting out every meeting with that, or maybe they have kind of some of their own processes where, every meeting starts with a safety debrief, or maybe they talk about a value, those types of things. So I think it's probably pretty hard to put a dollar return to it, but you can certainly put some other maybe softer measurements to it. So
what's interesting to me to hear you say that, and then go to you, Don, is that yes, it is hard to put a dollar value, and yet one would think that most investors want to have a dollar value to this. I mean, the whole point of this is to get a return on investment. There's got to be, how do I know if I'm an investor that this is worth spending my money on? Don, what were you saying about that?
Well, I think there are tangible financial results that culture can impact. So one thing, I have a portfolio company that had a problem with turnover, right? So you can look at retention and turnover and can identify how much does that really cost the company. So in this company's instance, it costs us about $1.2 million per year.
Wow. That's
direct hit to the bottom line of EBITDA. So if we're going to go sell the company for 8x, so that's a $10 million problem that you have, right? Wow. So, and if you can fix the culture and drive down the turnover, that can have amazing financial results. So culture's real and it has a financial impact. And so when we're evaluating a new investment, we are looking at what their retention is, what their turnover is, because that's a leading indicator of the culture. We'll look at Glassdoor ratings and you have to take those with a grain of salt. But again, it's one indicator of applicants or former employees talking about the culture of the company. And then, we try to dig in and vet whether that's real or not real.
So your example of turnover as a very measurable, quantifiable financial impact is interesting. So as you do that, you see lots of ways of calculating, what the people will quote for every person who leaves, what it costs to replace them. What calculator do you use in your own thinking about you're measuring that $1.2 million problem? How do you measure that?
By many of the things you just said, it's how much did we spend training that person? The recruiting fees to get their replacement, the customer loss, right? When you have turnover, right, that's not good for your customers, right? They have domain knowledge of your business and they serve your customers. And if they leave, you've got to get new people on board. that can learn the process, learn the culture, know how to take care of customers, know the technical details of customers. And many times if you have a high turnover, that leads to losing customers.
Yeah.
So,
Yeah.
that 1.2 million was kind of made up of all those types of items that went into that calculation.
Do you have a specific way that you if you're looking at generic company X, is there a way that you factor all those things and say, okay, we use, if you combine all of those factors, the training, the replacement cost, the hiring cost, the potential lost customer costs, we give it a factor of X times the average salary is what we think turnover cost is. Do you have a number like that, unless that's proprietary for you in some way?
No, I think for us, we just, the human resource department broke it down. So like we look at turnover, how much of it was voluntary, how much of it was, people retiring, how much of it was going for, lost pay, how much of it was job satisfaction, didn't have a career path. So we start with that, understanding the turnover that way. And then simply we track all those costs to train. It costs 4 weeks to train a technician in one of my portfolio companies. That has a cost to it, right? And then the recruiting fees that we spend, and on Indeed and hiring recruiters, that's very tangible. So we really just kind of take the tangible. In that 1.2 million, we didn't even include lost customers. If I would include that on top of it, would have been more.
Wow.
Yep.
And David, I think in our business, kind of speed has value, meaning, we've got a limited amount of time, right? There's a window for us to make an investment, work with the company, improve the company, grow the company. And, I think it does vary by position, right? If I've got, one position might be 3 to 6 months to bring a new person in, to bring them up to speed, to be able to kind of efficiently do that job. There may be other positions that are, a year and a half for somebody to kind of come in. One, we've got to do some sort of recruiting process, multiple months. Then we got to bring them in, and they've got to kind of figure out who to talk to, and the role, and how to kind of just really understand the company. That might be a year and a half. So, I think there's the direct dollar impact that, Don's talking about, that I do think is hard to measure. I've read a lot of different things on it, and it's years, multiple years, of kind of annual compensation, pick your number. I think you can spend a lot of time on that for sure, but it's definitely a real number, and it's the speed component. It also has value that, again, is hard to kind of put a direct number on it, but it can really set you back. The wrong person leaves for the wrong reasons, and reasons that could have been addressed. It sets us back. A year. I mean, that's not good. That's not a good outcome for anybody.
The other thing I think about when I think about, just again, I'm focused here on the financial impacts of this. I'm often asked when I'm doing a Vistage talk about the financial impact, and I cite when I sold my first company, and I think about, and this better than I do, that companies are going to be worth some multiple of their EBITDA based upon the timing and the industry and other factors. But if I look at when I sold my first company, and I think about the multiples that were being paid in that industry at that time, and the multiple that we were able to achieve as a seller, there was a significant difference between standard multiples and what we were being paid. And a big part of that was, it was because we had built something beyond just a set of numbers there. We had built something that was more sustainable. And I suspect, so this is how I think of it, but I'm curious about your perspective, that when you're buying a company, and I think when the company that bought our first company, they looked at us, they're thinking about, how likely can we sustain and grow the platform that's been built here? And if that culture is really powerful, there's a higher probability that you're going to be able to grow from there. If that culture isn't so strong, there's a less likelihood. And so they were willing to pay more for that platform that we had built than some other platform with the same underlying EBITDA at the time. Is that an accurate way of thinking about that from your perspective?
Yeah, for sure. I think that goes back to our VAM methodology, value acceleration methodology. I mean, that whole platform, that system that we use is really about scaling and professionalizing businesses. And so, the exact same company doing the exact same EBITDA in the exact same industry, one has built, a system that's scalable. It's professional. The systems are scalable. The culture's scalable. The turnover's low versus the exact same size company, exact same industry, which is maybe they've had good growth, but things are kind of in shambles, not all that professionalized, some high turnover, culture's not great, nobody's really happy, nobody's not as engaged as they should be. I mean, it just goes without saying that first company is going to be way more valuable. The next buyer, whether that's a family office, whether that's another private equity group, whether that's a strategic, they want a company that's going to flourish under their ownership. And, you'd much rather have the first one to start with, for sure.
Yeah. Yeah. You're smiling about that, Tom.
Yeah. Many times it's, we'll do add-on acquisitions to grow a company, and we want to make sure that there's a foundation in place before we go out and acquire other companies. And part of that foundation includes the culture, being a culture that can be adopted by the add-on, and making even sure that the add-on culture, in my career, some of the add-on acquisitions that have not gone well have been culture disconnects.
Yes.
And we thought that we were on the same page with them, but as soon as, we brought them into the fold, they just kept resisting and trying to do business their way and not the culture of the company.
Yes.
And, that's, in my experience, that's when add-ons can go bad, when you just don't have that melding of the cultures.
Yeah, I've seen that myself as well. And it's something I talk about with people all the time, that when they're practicing a set of fundamentals, it becomes easier to do that add-on, assuming that they're receptive, because as soon as they come in, you can roll out your fundamentals, and we're all on the same language and the same way of thinking. And this week we're on number 16, and across the whole company, everybody's on the same page. It makes it a lot easier to think of it as we're all one, because we have that common language, that common methodology, versus some other way of, well, how do you integrate these cultures?
Yep. And it helps for us in recruiting as well, because, the labor market cycles. I think we're on the employer side now, but it was, way to the employee side a few years ago. And you've got to differentiate yourself as a company, and to be able to, sit down with a candidate and, we've got, these are our values, and talk to a candidate about value. It's a real differentiator, and you have to differentiate yourself in this market.
Yeah.
I work with a CEO that, I don't know, was probably 4 or 5 years ago, kind of left me with a real nugget, which was, I'm not sure the exact words he used, but it was really like, if you bring in a new hire and maybe they're not perfectly aligned from maybe values or culture, if you bring them in and are intentional about it, they can absolutely, 90% of the population absolutely will be shaped by the rest of the team if it's laid out and it's obvious. I think, bringing somebody in, maybe not 100% aligned at the beginning, and letting them just kind of wander, it's sure to create a problem. And so he said it much more eloquently than that, but you get the idea, which is like, here's the roadmap. I mean, it's just like, think about a sports team, right? If the sports team's culture is you go into the locker room, everything's ticked and tied, and, everybody knows what they're doing, the new player, even if they don't come from that culture, they are going to assimilate into that particular style. Or maybe somebody's really buttoned up and they come into the locker room and it's craziness in there all the time, and it's it's inappropriate and bad behavior, and guess what, that person that's really buttoned up, they're going to come in there first couple of days, they are going to absolutely assume the craziness, bad behavior type of atmosphere. So 90% of the people will shape themselves to the broader group. And if the broader group is defined and squared away, one thing we haven't talked about is the discipline side of culture, which is, I think, the hardest part, which is, disciplining bad behaviors and bad cultural behaviors and actions. So maybe that'll be for another time. But anyways,
So just piggybacking what you're saying about the CEO that was sharing that point of view with you, and I certainly agree with that. And the way that I describe it, I talk about that in actually all of my talks, that I describe a bell curve that the numbers aren't, who knows what the numbers actually are, but the way that I describe it is 10% of the people are going to be amazing people no matter where you put them. You could put them in the worst possible environment and they're just standouts, and they're going to stand out. I don't care where you put them. And there's 5 or 10% of people who aren't going to be very good. It doesn't matter where you put them. But there's about 80% in my view, who knows, it could be 90, but somewhere in the 80% area that will go with the flow. That you put those people in a high-performing environment, and even unconsciously, they will look around and figure, I guess that's the way they do it around here. And they'll fit themselves into that. And you put the exact same people in a low-performing environment, and 80% of those people will simply conform to the environment that they're in, which is why it becomes so important to purposely create that environment, to do that in a way that affects people. And, when you talk about sports teams, because at the risk of overdoing sports analogies, but they're often very appropriate because they're a team. They're trying to work together to achieve a goal. So there are a lot of things about sports analogies that are very relevant here. And for our listeners' sake, we are all in the Philadelphia area, and I'm assuming you guys like me are big Eagles fans. I hope so. We should be. And I look at the Eagles have done a fabulous job with that. That you hear all the time about players. They just picked up a couple players at the trade deadline, and you listen to the quotes, and they talk about how everybody's welcomed them, and they love the standard here, and they see how things are done, and that makes a difference. That players come in and they're going to play different on the Eagles than they would on a different team, because there's a standard about the way we think. You hear the Eagles offensive line coach Jeff Stoutland talk about that, and all the offensive line players, that there's a standard on that offensive line about how we do things here. And you bring somebody into that culture, they're going to conform to that. It affects people in a profound way.
Well said.
Yeah. Just to piggyback on your point, Lane, about the discipline. One of the things I talk about in all the talks that I do is that the ultimate accountability for your culture is the willingness to get rid of somebody who is typically a high performer, but is not a fit in the culture we're trying to create here. And when I ask leaders, how many of you have ever done that? Most people have done it. And when I ask them, like, what did you say to yourself afterwards? They almost always say, I should have done this a long time ago. That, that the strongest message you can send is when you get rid of one of those people. It tells people that we're not kidding around here.
I think the fear is always that the person has some domain knowledge that isn't documented somewhere, but I don't know. And I know management teams agonize over the decision to do it, but I haven't seen a single example where it didn't work out for the benefit of the company and the benefit of the culture. Because I think other employees around these problem, poison employees, cancers, whatever you're going to call them, it has an impact on the rest of the culture. If you're going to tolerate that, that just sends a terrible message to the rest of the employees.
It does. To that point, Don, I often say the best way to know somebody's culture is to look at the behavior that they tolerate. As you said, you know, well, it's all nice that you put all this stuff on the website, but what do you allow to continue to go on in the company? That's the real culture. I mean, you talked about the safety one, the example that you were talking about with somebody had lost a finger and they kept going. Well, they could talk about safety all they want, but what they were tolerating was something much different than that. And I've seen the same that you're describing, that almost never do we lose the things we feared losing. We thought we were going to lose the customers or the domain knowledge or whatever, and it doesn't happen. And then they're kicking themselves saying, darn, I should have done this a long time ago. Why did we wait so long? And often when they get rid of that person, there were bigger skeletons in the closet than they even realized, which is a little scary too.
Yeah. No, I think you nailed it. You think about what I think everybody calls them kind of C players, right? They're folks that are really good at their job, but just not a culture fit, versus a B player, which is great culture fit, but maybe has some room to improve on their job. And think about the machinist, who's your best machinist, but is just an absolute culture in the shop, a cancer in the shop. Sorry, and really hard to get rid of them. I get it. It is very hard to get rid of them, but I tell you, the rest of the team will elevate when that cancer leaves, and it just you can't be held hostage by that. If you don't want to be on the bus, great. There is an awesome place for you. We will help you find the best place for you, but it's probably not here. So tough, easy to say, easy for me to say, a lot tougher to do, but it is a big key to driving the right behaviors and culture, for sure.
I was doing a podcast, and I'm trying to remember who it was that I was speaking to recently, but they had an interesting way, a simple, but I thought very helpful way of thinking about the two aspects of the job. You're talking about, Lane, maybe they're good at their function, but they're cancerous. And the way that this person described it is they talked about the how and the what that somebody does. And so when they're evaluating somebody, even in performance reviews and other things, they have both a what and a how portion. The what is the job you actually do, and your effectiveness at that. The how is how you show up, in our team. And they talk about that the how is just as important as the what. And there are some people that are good at the what, but they're not very good at the how they show up as a member of this team. And I thought that was just sort of an interesting nomenclature. I hadn't thought of it quite that way before, but a simple way of describing to somebody that both of these are important. It isn't just that you bring in enough business. It's how you work with your teammates and customers and others. So that was sort of an interesting description.
Very interesting. Yep.
Yeah. So this has been a fascinating conversation. I really appreciate both of you sharing from an investor standpoint how you look at this. I'm curious, as we bring this to the close, I'm always interested in kind of lessons learned. And so I'll ask each of you, I'll start with Lane. If you think about, all the companies that you've worked with, I mean, you guys as a firm, as you said, have done 140 platform investments. So I know each of you weren't involved in all 140, but you've both had a lot of experience working with a lot of companies. You've seen some things that have gone really well, and you've seen some things where you think, man, I made a mistake there, and I learned from that. I'm always interested in the biggest learning. So, Lane, what was without giving names, what was the biggest thing that maybe a mistake you made along the way, especially as it relates to culture, that you learn something from, and you say, now I do this differently because of that experience? Of course, I'm cheating that Don gets a chance to think about this.
Yeah, no, that's good. That's good. So I'm going to answer, and then I'm going to flip it a little bit, maybe for you. So I think just what we were talking about, when you see a problem that can't be fixed, can't be remediated, and it's, negatively impacting others, it's tough to take action. I mean, I get it. It's just, maybe things aren't that bad today. And the next thing you know, we're a month down the road. And the next thing you know, we're 6 months, 2 quarters down the road, and still haven't taken action. And, you just find yourself in this kind of stasis, I guess. So, I think taking action early when, there's a problem, and that can be up and down the organization from the absolute top to the absolute bottom. It isn't just a top level thing. But really hard to do. But I guess the lesson I've learned is leadership wins. And again, maybe this is another topic for another show, but, we've been blessed with working with some fantastic leaders, and I've seen leaders turn businesses around where maybe the industry wasn't great. Maybe you was facing some headwinds. Maybe there was some kind of real things that were not in the favor of the company or the industry, and a good leadership team driving the right culture, the right behaviors, absolutely has turned those companies around, and they've been good investments for us. And so that's kind of that's
a great. Don and I were talking about that a little bit before we started this podcast, and we were just sort of chit chatting. We were both recognizing leadership is everything. The best
Absolutely.
leaders, and I see the best leaders, I always say, implement everything they do better. It doesn't matter whether they're implementing fundamentals or lean thinking or your VAM or anything else. They just do everything better. Yeah.
And they can get people to run with them, you know, so you get you get this complete alignment. Yeah,
Absolutely.
It's amazing. It's amazing.
All right, Don, what's your biggest lesson?
I just pile on that.
Okay.
It's leadership sets the tone. And I'm staring at my whiteboard. At the top of my whiteboard, I have all the qualities of CEOs that I admire and that have, you know, great leaders within the Argosy portfolio. I think have these qualities. And one of those qualities I have is culture first. And if you have a CEO who doesn't value culture and doesn't put culture first, that's tough for us to make a decision to hire a person like that. Even though they've got great credentials, they've grown companies, it's super important for us that they be a culture first, lean into culture type leader.
You know, from a timing standpoint, that resonates so strongly with me. And yesterday, literally yesterday, as we're recording this, I was in Houston yesterday, and I was working with one of our longtime clients, and we were updating their fundamentals, and we were rolling it out to their staff, again, at an all-company meeting. And this CEO is so committed and so passionate about their culture that he was telling his staff, don't make any misunderstanding. This is the number one absolute most important thing in our company. And he said, I get tears about this. I get emotional about it. Nothing is more important to me than this. And he was just in front of his people with that level of commitment. And you know, they've been successful. They're going to be successful. And I contrast that with, I think about some leaders we've worked with. I'm thinking about without naming names, a CEO that says culture is really important, but behavior doesn't necessarily reflect that. And I think we were facilitating the brainstorming of their fundamentals in a session, and he was late for the session, and he told the staff just to get started without me. And you think, okay, all right, I don't think this guy really gets it. But I contrast those two examples of one guy standing in front of his company. He uses the phrase, I will go to the mat about this. Like, he will not compromise on how important this is to him. But it goes right to your point, Don. Yeah, it's everything.
It's great.
Well, this has been great. I really appreciate both of you sharing. I know it'll be a lot of benefit for our audience. Thank you so much for being part of our podcast.
Yeah,
Thanks, David.
Thanks for having us, David. Yeah, awesome.
And that wraps up today's episode of Culture Architects. If you're enjoying these conversations, subscribe on your favorite platform and also consider leaving a quick review, and that way other culture-minded leaders can find the show. And for more tools on building a high-performing culture in your organization, visit CultureWise.com. See you next time on Culture Architects.
This has been Culture Architects with David J. Friedman. Join us next time for more insights and wisdom from great leaders in all walks of life. To book David for your next event or to learn more about his writing, speaking, or consulting, go to davidjfriedman.com. Culture Architects with David J. Friedman is a production of CultureWise.